13,000 people are about to wake up rich. Not lottery rich, generational rich, the kind of rich where your grandkids are still living off a decision you made years ago by taking a job at a rocket company and getting paid partly in something most people would have thrown in a drawer and forgotten about. In a few days, that drawer turns into a NASDAQ ticker and the single biggest IPO in the history of the planet goes live. 13,000 people inside that building are set for life. The only question left is whether anybody outside the building gets a seat too. Whether someone like you, with a normal income and a normal brokerage app, can grab a piece of this, or whether you just watch it happen on the news like every single time before. Because this time, something is genuinely structurally different, and that difference is the entire reason you're here. My name is Nick, and I have spent an unhealthy amount of my life pulling apart the question of why some people end up on the inside of these wealth events, while the rest of us find out about them on the news afterward. If you have ever watched a company you loved go public and felt that quiet little gut punch of, man, I should have been part of that, then stick around and hit subscribe because today we are going to do something genuinely fun. We are going to break down exactly how thousands of people are about to get rich off the biggest IPO in the history of the world. And then, line by line, route by route, we are going to answer the only question that actually matters to you. Could you? And I'll tell you up front. There are exactly 4 ways a regular person can get a piece of this. 3 of them you've probably half heard of. The 4th one, the one that's actually wide open to you with $100 and a phone, almost nobody is talking about, and I'm deliberately saving it for last. So stick with me to get there. So let me tell you what is actually happening here, because this is not a rumor anymore. For about 15 years, SpaceX is going public was the financial world's version of, this is the year the Lions win the Super Bowl. People said it constantly, nobody believed it. Elon Musk himself spent more than a decade swearing up and down that he would keep the company private because the whole point of SpaceX is a 30-year mission to get humans to Mars, and you cannot run a 30-year mission while a bunch of Wall Street analysts scream at you every 90 days about quarterly earnings. That was the line. For years, it held, and then it didn't. As I'm recording this, SpaceX has filed its paperwork with the SEC, made its prospectus public, and locked in a plan to list on the NASDAQ under the ticker SPCX. The roadshow is wrapping up. The price is set at $135 a share. The trading debut is targeted for just a few days from now, and the valuation they're going public at is roughly $1.75 trillion. Trillion. With a T, let me say that number a different way so it actually lands, because at this scale, the human brain just kind of glazes over. $1.75 trillion is more than the entire GDP of countries like Australia or Spain. It is a single company that builds rockets worth more than most nations on Earth. And here's the part that should make you sit up, because this is the whole reason we are having this conversation. SpaceX is reserving around 30% of this offering for regular retail investors, not hedge funds, not pension giants, not Goldman Sachs's best clients, regular people with regular brokerage accounts. Now, before we go any further, I have to say the boring but important thing. I am not your financial advisor. This is not financial advice, and nothing in this video is me telling you to go buy anything. These are the mechanics, the math, and the honest trade-offs. What you do with them is entirely your call. Cool? Cool. Because once you understand why that 30% number is such a big deal, you're going to understand this entire game differently. Let me put the size of this thing in perspective, because biggest IPO in history gets thrown around a lot, and most of the time it's marketing. This time it's just true. SpaceX is looking to raise somewhere in the neighborhood of $75 billion in this offering. The previous record holder for the largest IPO ever was Saudi Aramco back in 2019, and that's not some scrappy startup, that is the literal oil company of an entire kingdom. And they raised about $29.4 billion. So SpaceX isn't edging past the old record, it is more than doubling it. It is taking the biggest IPO that has ever existed and lapping it. And the wildest part of the whole story is how fast the price ran up to get here. I want to walk you through this ladder because it tells you everything about who already made money and how. At the end of 2024, SpaceX did one of its regular insider sales at a valuation of about $350 billion. Big number, obviously. Then in the summer of 2025, it climbed to 400 billion. By the end of 2025, 800 billion. Early 2026, after folding in Musk's AI company in an all-stock deal, 1.25 trillion. And now the IPO target, 1.75 trillion. So in roughly 18 months, the value of this company went from 350 billion to 1.75 trillion. It multiplied by 5 in a year and a half. Now, here's the thing about a number climbing like that. Every single time it jumped, somebody on the inside got to sell some shares at the new, higher price. That is not an accident. That is the machine working exactly as designed. And to understand how thousands of people are about to get rich, you have to understand who was standing inside that machine the whole time. So let's talk about them. Let's talk about the people who are actually getting rich, because thousands of people is not a figure of speech. It is close to a literal head count. Start with the employees. SpaceX has somewhere around 13 to 18,000 employees holding equity in the company, stock options, restricted shares, the whole package, and SpaceX has done something for years that most private companies never bother with. Roughly twice a year, it runs what's called a tender offer. In plain English, the company organizes a big buyback where employees and early investors get to sell a chunk of their shares, usually 10 to 25% of what they've got vested at a set price. It is a pressure release valve. It let people who'd been there for years actually touch some of that paper wealth without the company ever having to go public. And every one of those tender offers is what set those valuation milestones I just walked you through. The company sells you on a dream, you take options instead of a fatter salary. The options sit in a drawer, the valuation climbs, and twice a year you get to cash a little out. And let me put a face on that, because thousands of people getting rich stays abstract until it's one actual person. Picture a senior engineer who showed up early, took the stock options instead of a bigger paycheck, and just held on. The kind of person whose half-forgotten drawer of equity is now worth around $4 million. That is not a fantasy I invented for drama. That is the median outcome for a senior person who showed up early, took the equity, and just held on. There are people who walked onto that factory floor in 2010 making less than they could have made at Boeing, and who are now, on paper, worth more than the doctors and lawyers their parents wanted them to become. Let me actually run the math on that, because it's the kind of thing that sounds made up until you put real numbers to it. Say you joined SpaceX in 2013 as a mid-level engineer, and they granted you options on, let's call it, 10,000 shares at the valuation back then, adjust for the stock split they did, and the price of a single share back then was a tiny fraction of where it is now. Through every one of those tender offers, you sold a little, paid off your student loans in 2017, put a down payment on a house in 2019, took the family to Japan in 2022, and you still had the bulk of it sitting there. The shares you held through to this IPO at $135 a piece are the difference between a comfortable career and never having to work again if you don't want to. That's not a lottery ticket. That's 16 years of showing up, paid out all at once. And there are thousands of versions of that person walking around Hawthorne right now, quietly refreshing their brokerage app. There is reporting that the company's president and chief operating officer, Gwynne Shotwell, who was employee number 11, by the way, she joined back in 2002, is sitting on a stake worth over $1 billion. The chief financial officer, same story, north of $1 billion. One of the early directors is reportedly looking at something in the neighborhood of $70 billion. 70. That is not a typo, and I did not stutter, and Shotwell, for what it's worth, gave a rare interview earlier this year where she was asked about the IPO and basically said she's not really supposed to talk about it, but that she's genuinely looking forward to it. A whole new set of tools for running the company. When the person who's been there for over 20 years and is about to be a billionaire sounds excited rather than nervous, that tells you something about how the inside feels about this. But the employees are only half the story, because the people who really, truly hit the jackpot are the early investors who wrote checks when this company looked like it might die. And it almost did. In 2008, SpaceX had failed its first 3 rocket launches in a row. Musk was nearly broke, pouring the last of his PayPal money into the thing. The 4th launch was basically do or die. And right around that desperate moment, a venture capital firm called Founders Fund, co-founded by Peter Thiel, wrote a $20 million check. $20 million into a company that had failed 3 times and was running on fumes. Now, here is what that $20 million turned into. According to reporting on the firm, Founders Fund's gain on SpaceX since that 2008 bet is more than $19.5 billion. Their entire firm, every other investment they have ever made, all of it combined, manages around $17 billion. So their winnings on this one company are worth more than their entire fund. The appreciation on that bet works out to something like, and I genuinely had to check this twice because it reads like a typo, 62,000%. I'm going to let that sit for a second, 62,000%, and then there's Google. Sorry, Alphabet, its parent company. Back in 2015, Google invested $900 million into SpaceX when the whole company was valued at around $12 billion. A regulatory filing in 2026 revealed that Alphabet's stake had grown to a little over 6% of the company. At a $2 trillion valuation, that 6% is worth roughly $100 billion. So Google put in $900 million and turned it into something like $100 billion. That is a 64 times return, and it sits quietly on Alphabet's balance sheet as one of the most profitable side bets any tech company has ever made. Fidelity's got a big chunk. Sequoia's in there. Andreessen Horowitz led around. The list of people who are about to look like geniuses is long, and it is real. So when the title of this video says thousands of people are about to get rich, I need you to understand that I am not exaggerating for the thumbnail. Between the employees with equity and the funds and the early backers, you are looking at thousands of individuals whose lives are about to change because they were standing in the right room at the right time. The question, the entire question, is how the rest of us get anywhere near that room. And to answer that, you first need to understand how this whole IPO machine actually mints millionaires in the first place. Because it's weirder and more rigged in the insider's favor than you'd think. Here is how an IPO actually works. Stripped of all the jargon, a private company decides it wants to sell shares to the public. To do that, it files a giant document with the SEC called an S1, which is basically the company taking its shirt off in public for the first time and showing everyone its finances, its risks, its secrets, all of it. Then it hires a syndicate of investment banks, in SpaceX's case, more than 20 of them, led by Goldman Sachs. And those banks go on what's called a roadshow, flying around, pitching big institutional investors, taking their temperature, figuring out how much demand there is and at what price. And then comes the part that should make you a little angry, or at least a little awake. When the IPO prices, the banks decide who gets the shares at that initial offering price. And historically, about 90% of those shares go to the big institutions, the hedge funds, the pension funds, the mutual fund giants. 90% straight to the club. And the 10% that's left over, that's the table scraps the rest of us are supposed to fight over and feel grateful for. Then on the first day of trading, the stock very often pops. It opens higher than the price the insiders paid. There's actually solid data on this. A finance professor named Jay Ritter has tracked thousands of IPOs going back to 1980, and across more than 8,000 of them, the average first day return is about 17.9%. So the institutions who got allocated shares at the offering price are frequently up double digits before lunch on day one, just for being in the club. Meanwhile, the founders and employees can't sell anything yet because of something called a lockup. A lockup is a period, usually 90 to 180 days after the IPO, where insiders are legally barred from dumping their shares onto the market. The whole point is to keep the people who own the most stock from flooding the market the second it opens and tanking the price. SpaceX's lockup is structured in a rolling way. After the first earnings report, insiders can sell a slice, then a bigger slice, with the whole thing fully unlocking around 180 days out, roughly December of this year. Musk himself has to hold the entire time. Keep that lockup date in your back pocket, because it's going to matter a lot when we get to the part about whether you should buy. So that's the machine. File, roadshow, allocate mostly to insiders, pop on day one, lock up the founders, release them later. Now, does this machine actually create thousands of millionaires, or is that just a nice story we tell? Let's check the receipts, because history here is almost suspiciously consistent. Go back to Google in 2004. They priced their IPO at $85 a share. The stock closed its first day around $100, up 18%. And here's the detail I love because it cuts straight through all the abstraction. The Google IPO reportedly turned most of its roughly 2,500 employees into millionaires, and not just the engineers and executives. The in-house massage therapist who'd taken some equity instead of a bigger paycheck became a multimillionaire. The company chef, same thing. There are estimates that within a few years, around 1,000 people connected to Google were holding more than $5 million in stock each. The masseuse. Think about that. The next time someone tells you equity is just monopoly money. There's a guy out there who gave back rubs at a search engine startup and retired wealthy because he said, sure, I'll take some shares. That's the kind of thing that happens exactly once in a company's life, and it happens on IPO day. Then there's Amazon, which went public in 1997 at $18 a share. If you had put $10,000 in at that IPO and just done nothing, no trading, no panic selling during the dot-com crash, no touching it, that stake would have grown to something like $16 million a couple decades later. One economist who studies this stuff estimated that Amazon created on the order of $1.6 trillion in net wealth for shareholders from its IPO through 2020. So from a company that for years Wall Street openly mocked for never turning a profit, for plowing every dollar back into growth, for refusing to play the quarterly earnings game. Sound familiar? Because that is almost word for word the criticism people throw at SpaceX right now. Hold that thought, because we're going to come back to it when we talk about whether the price makes sense. Tesla, Musk's other company, so this is the fairest comparison we've got, went public in 2010 at $17. The stock popped over 40% on its first day, and a $10,000 investment at that IPO was worth roughly $2.6 million about 12 years later, once you adjust for all the stock splits. Let me reframe that. 10 grand. The price of a used Honda Civic turned into more than $2.5 million by betting on a Musk company that, at the time, half of Wall Street was convinced would go bankrupt. I'm not saying SPCX will do the same. I'll get into exactly why it might not in a minute. But the track record of betting against this specific guy's companies is, let's say, not great. Facebook went public in 2012 at $38 and famously stumbled out of the gate. The stock actually dropped for months after the IPO, and everyone called it a disaster. But it still reportedly minted around 1,000 employee millionaires, and Peter Thiel, yeah, him again, the same guy from the SpaceX story, turned an early $500,000 bet into more than $1 billion. And Airbnb went public in 2020, priced at $68 and opened the next morning at $146. It more than doubled on day one, instantly creating a fortune for its roughly 2,400 employees, a lot of whom had spent years renting out their own spare rooms while building the thing. So yes, the pattern is real and it is remarkably durable. When a genuinely dominant, beloved, world-changing company finally goes public, it tends to create wealth on a scale that is honestly hard to comprehend, and it does it for thousands of people at once. SpaceX is by almost any measure, a more dominant company in its field than most of those names were on their IPO day. Google had competitors, Facebook had competitors, but nobody is even close to SpaceX in launch. Which brings us to the obvious question hanging over all of this. Why is everyone so convinced SpaceX is the real deal and not just hype with a rocket strapped to it? Because the bull case here is genuinely, legitimately exciting, and I want to give it to you straight before we get into the colder math. Here is what makes SpaceX special, and it's not actually the rockets. I mean, the rockets are insane. In 2025, SpaceX accounted for around half of every single orbital launch on the entire planet and launched something like 85% of all the satellites that went up. Now, they are not the market leader in space launch. They are basically the whole market, with everyone else fighting over the scraps. But rockets, as a business, are lumpy and expensive and hard. The thing that turned SpaceX from a cool engineering project into a $1.75 trillion company is the constellation of internet satellites called Starlink. And Starlink is where this gets beautiful from a business standpoint. Yeah, as of early 2026, Starlink has over 10 million subscribers across more than 155 countries, a number that doubled in a single year. It pulled in around $11.4 billion in revenue in 2025, up roughly 50%, and it's profitable with an adjusted EBITDA margin north of 60%. 60%. Do you understand how rare that is? That is software company economics. The hard part, designing the satellites, building the rockets, getting the things into orbit, is mostly a sunk cost now. Once the network is up there, every new customer who signs up is almost pure margin. They're selling internet to cruise ships at $34,000 a year per vessel. They're selling it to airlines for around $300,000 a pop. They are wiring up the parts of the planet that no cable company ever wanted to touch, and they are doing it from space at margins that would make a tech founder weep with joy. And here's the part of the Starlink story that I think is genuinely underappreciated, the thing that turns a good business into a fortress. To compete with Starlink, you don't just need a better satellite. You need to put thousands of satellites into orbit. And to do that affordably, you need cheap, reliable, reusable rockets that launch over and over again. And who has the cheapest, most reliable, most frequently launched rockets on the planet by a margin that isn't even close? SpaceX. So SpaceX is the only company on Earth that owns both the rockets and the satellite network. They are their own launch provider. Their competitors have to go rent rockets, frequently from SpaceX itself, which is a little like having to buy your bricks from the guy you're trying to outbuild. That vertical integration is the moat. It's not that nobody else has the idea. It's that nobody else has the launch capacity to make the idea cheap, and building that launch capacity from scratch would take a decade and tens of billions of dollars, assuming you could even out-engineer them, which so far nobody has. That's why the subscriber number keeps doubling and the competition keeps not showing up. Over 10 million subscribers, and the curve is still bending upward, in part because every quarter the service reaches places that have literally never had fast internet before. Rural farms, remote islands, disaster zones, container ships in the middle of the ocean. There are entire categories of customer that have no alternative and never will. And for those customers, Starlink isn't a nice to have, it's the only option on the menu. That is the kind of pricing power that builds empires. And that's before you get to the moonshots. And I mean that literally. There's Starship, the fully reusable monster rocket designed to drop the cost of getting a kilogram into orbit through the floor. If they pull it off at scale, it doesn't just help SpaceX, it resets the economics of the entire space industry, and SpaceX owns the toll booth. There are massive defense and government contracts, including a militarized version of Starlink that the Pentagon is extremely interested in. There's NASA leaning on SpaceX for missions back to the moon, and there's an even wilder long-term idea about putting AI data centers in orbit where solar power is constant and cooling is free because, well, space is cold. Any one of those on its own could be a giant business. The bet you're making with SpaceX is that the same team that already dominates launch and already dominates satellite internet has 3 or 4 more of those swings still in front of them. Cathie Wood's ARK Invest, love her or hate her, she calls big tech trends early on, projects that SpaceX could be worth around $2.5 trillion by 2030, and argues the 1.75 trillion IPO price is actually grounded in a believable trajectory, not fantasy. And there's a bigger, almost philosophical reason this IPO is different from a normal one, which I think is worth 30 seconds of your time because it changes how you read the whole thing. Most companies go public because the founders and early investors want to cash out. That's the quiet truth behind a lot of IPOs. The party's basically over and they're selling tickets to the after party. SpaceX is, at least according to its own pitch, doing the opposite. It's raising $75 billion to fund the most expensive engineering project in human history, building Starship into a vehicle that can carry people to Mars. Musk has been blunt about this for 20 years. The entire point of the company, the reason it exists, is to make humanity a multi-planet species. Whether you think that's visionary or completely unhinged, it means the money you'd be putting in isn't funding somebody's exit. It's funding the actual mission. That's a genuinely unusual thing to be able to say about a stock. Now, I do have to flag one wrinkle in all of this because it matters and because I promised you the honest version. Even after this IPO, Elon Musk keeps ironclad control of the company. Through a special class of shares that carry 10 votes each, he'll control around 85% of the voting power, even though he owns something closer to 40% of the actual equity. SpaceX is going public as what's called a controlled company, which lets it skip some of the normal governance rules. In practical terms, that means when you buy SPCX, you're buying the economics, your share of the profits and the growth, but almost none of the say. You're a passenger, not a co-pilot. For some people, that's a deal breaker. For others, betting on Musk is the entire reason they want in, and handing him the controls is the point. Oh, and his own pay package is so deranged, it's almost funny. A chunk of his future shares only vest if SpaceX hits a $7.5 trillion market cap and establishes a permanent colony of 1 million people on Mars. Most compensation plans ask you to hit a sales target. This one asks you to colonize another planet. I just think that's worth saying out loud. So that's the dream, and the fine print on the dream: genuine market dominance, software-grade margins on the part that matters, and a stack of moonshots, any one of which could be enormous. Now, take a breath, because here's where I have to be the friend who actually cares about your money instead of the friend who just wants you to feel good. We've spent the last 20 minutes on why thousands of people are getting rich. Now we get to your question. Could you? And the honest answer is yes, there are real ways in, more than usual, but every single one of them has a catch, and I am going to walk you through all 4 so you can decide for yourself. Route number 1 is the most exciting and, for most people, the most disappointing: requesting shares at the actual IPO price before the stock starts trading. Normally, and I cannot stress this enough, normally this door is welded shut for regular people. The shares go to the institutions, but this time, SpaceX has reserved that roughly 30% of the offering for retail investors, which is triple the usual carve-out, and they've made it available through a handful of mainstream brokerages: Charles Schwab, Fidelity, Robinhood, SoFi, and E-Trade. So if you have an account at one of those, you can submit what's called an indication of interest during the roadshow window and request to buy shares at that $135 price. So picture it. It's the morning of the debut. You open your Robinhood app or your Schwab app, and there it is, SpaceX, right there on the screen with a little button to request shares at $135. Your thumb is hovering over it. Feels like the door's wide open, right? Here's the catch though, and it's a big one. Demand for this is going to be absolutely biblical, and supply is fixed. Even 30% of the offering, spread across the entire retail investing population of America, is a thin slice per person. So you might request $1,000 worth and get filled for $200 or $50 or nothing. Schwab, for example, has historically required a six-figure account balance just to play in these things. Robinhood has rules where if you flip the shares too fast, you get penalized on future IPO access. So, could you get shares at the IPO price? Maybe. A little. It's worth trying if you want in, but do not build your whole plan around getting a meaningful allocation because you probably won't. And that's not pessimism, that's just arithmetic. Route number two is dead simple. Wait until the stock starts trading just a few days from now and buy it on the open market like any other stock. Any brokerage account on earth can do this. The upside is there's no gatekeeping, no allocation lottery, no minimum balance. You want $100 of SPCX, you buy $100 of SPCX. The catch is that you're buying at whatever frenzied price the market sets on day one. And as we just covered, hyped mega IPOs love to pop and then sag. The first day price is set by the most excited buyers in the world, which is rarely the price a calm person would pay. So route two is easy, but easy is not the same as smart, and we'll come back to timing in a minute. Route number three is the one that sounds the most exclusive and James Bond, and it's the pre-IPO secondary market. For years before any of this retail stuff, there were platforms, names like Forge Global, Equity Zen, and Hive, where you could buy shares of private companies like SpaceX from employees and early investors who wanted to cash out early, and people did. In early 2026, SpaceX shares were trading on these platforms at $600, $700 a share. But here's the wall. To use them, you generally have to be what the SEC calls an accredited investor. And that term has a very specific, somewhat insulting definition. To be an accredited investor, you need to either earn more than $200,000 a year as an individual or $300,000 as a couple for the last 2 years running, or have a net worth over $1 million not counting the house you live in, or hold certain financial licenses. That's the bar. And get this, those dollar thresholds have not been adjusted since 1982. The rule that decides whether you're allowed to invest in private companies is older than the Macintosh computer. It was written when a gallon of gas cost about 90 cents, and nobody's bothered to update it for inflation, which means more and more households technically qualify every year just because of how money has inflated. Around 18% of American households now clear the bar versus under 2% back in the 80s. But if you're not in that 18%, this entire route is legally closed to you, full stop. And even if you are accredited, these secondary deals come with their own landmines. You're often buying through a layered investment vehicle rather than owning the shares directly. The pricing is murky. The same share traded $634 on one platform and $750 on another in the same week, and SpaceX has the right to cancel your purchase under certain conditions. So it's a real route. It's just narrow, expensive, and full of fine print, which brings us to route number 4, the one I told you at the very start I was saving. And pay attention here, because this is the one that's actually open to everybody. No income test, no million-dollar net worth, no allocation lottery, no six-figure account balance. You can get exposure to SpaceX right now, today, through publicly traded funds that already own a piece of it, and there are several. The cleanest one is almost laughably boring. It's Alphabet, Google's parent company. As we covered, Alphabet owns somewhere around 5 to 6% of SpaceX, worth roughly $100 billion. So if you buy Alphabet stock, which any brokerage account can do, no minimums, no fees, fully liquid, you are buying a sliver of SpaceX wrapped inside one of the most profitable companies in human history with zero speculative markup. It is the least sexy way to get SpaceX exposure and possibly the smartest, precisely because you're not paying a premium for the privilege. Then there are the funds that specifically load up on SpaceX. There's the ARK Venture Fund run by Cathie Wood's shop, where SpaceX is the single biggest holding at around 17% of the whole fund. The catch there is it's what's called an interval fund. You can buy in, but you can only sell at certain windows, and it charges a fairly hefty fee of nearly 3% a year. There's the Barron Partners Fund, where SpaceX is an enormous chunk, close to 30% of the fund. And then there's the one I have to warn you about specifically, because it is the perfect illustration of how excitement can override math. It's a closed-end fund called the Destiny Tech 100, ticker DXYZ, and SpaceX is its largest holding. Sounds great, right? Here's the problem. A fund like this has something called net asset value, or NAV. That's the actual, real, added all-up value of everything the fund owns, divided by the shares. At the end of 2025, that fund's NAV was about $20 a share, meaning the stuff inside it was genuinely worth about $20 per share, and the fund was trading on the market at around $60 a share. So people were paying $60 to buy $20 of actual assets. Let me put that in human terms. That's like walking up to me and I'm holding a $20 bill and you hand me $60 for it because I drew a little rocket on it. That premium is not a bonus. It is a tax you pay for your own enthusiasm. And when enthusiasm fades, premiums like that have a nasty habit of collapsing back toward reality. So can you use DXYZ to get SpaceX exposure? Technically, yes. Should you pay triple for it? That's a much harder yes. So those are your 4 routes. Request it at the IPO price and probably get crumbs, buy it on the open market and ride the volatility, go through the accredited investor private market if you've got the income and the stomach, or get clean liquid exposure through Alphabet or one of the funds, just watching out for those insane premiums. 4 real doors, each with a different price of admission. And now I have to tell you the part that the people selling you pre-IPO SpaceX shares in your YouTube comments absolutely do not want you to hear. Because here's something that's going to feel completely backwards. The people most likely to lose money on this whole thing are not the skeptics. They're the people most excited about it right now. The ones who will smash the buy button at any price the instant it starts trading, precisely because they love the company so much. And I get it, the company is genuinely lovable, but loving the company and making money on the stock are 2 completely different skills, and confusing the 2 is the single most expensive mistake you can make here. So let me make absolutely sure you don't walk out of this video as one of those people. Here's the thing about a $1.75 trillion price tag. It is enormous relative to what this company currently earns. SpaceX, as a whole, brought in around $18.7 billion in revenue in 2025. That's huge. That's up 33%. That's a fantastic business. But at a 1.75 trillion valuation, you are paying well over 100 times revenue. Not earnings, revenue. And on a bottom line, generally accepted accounting basis, the consolidated company actually posted a loss of nearly $5 billion, largely because of folding in that AI company and its enormous cash burn. The combined entity is sitting on an accumulated deficit of over $40 billion and took on a $20 billion bridge loan. So you've got a wildly exciting growth story strapped to a wildly expensive price tag, and it is currently, on paper, losing money, and the people who do this math for a living are not all on board. Morningstar, one of the most respected independent research shops out there, ran their own valuation and pegged SpaceX's fair value at around $780 billion, less than half the IPO target. Their analyst put it about as bluntly as an analyst ever does, basically saying the company has been significantly overvalued and that investors will likely get chances to buy it cheaper after the IPO settles down, and that lines up with the broader history of IPOs, which I'd be doing you a disservice to skip. Because for every Amazon and Google, the data says a lot of IPOs disappoint. One big study found that 3 years after going public, almost 2/3 of IPOs underperformed the market by more than 10%. About 1 in 5 close below their offer price on the very first day. And those big, juicy first day pops, they frequently give back 20 to 40% within a few months as the hype cools and the lockups start to expire. I'm not telling you this to scare you off. I'm telling you this because the difference between getting rich off an opportunity and getting wrecked by one is almost never the opportunity itself. It's the price you pay and the patience you bring. So let me give you the part that actually matters, how a normal level-headed person might think about playing this without setting their money on fire. First, and this is permission you don't usually get from finance content, You do not have to do anything in the next 4 days. The single loudest voice in your head right now is probably the one screaming that if you don't buy on day one, you'll miss it forever. That voice is wrong and it is expensive. Remember the history. Mega IPOs routinely give you better entry points in the weeks and months after the debut than on the frenzied first morning. Remember, Morningstar literally said they expect cheaper prices after the IPO. And remember that lockup date I told you to keep in your back pocket around December of this year, when insiders are finally free to sell big chunks of stock. When a flood of new shares hits the market, prices often dip. A patient person watches for the first real earnings report this fall and that lockup expiration and lets the hype buyers overpay first. Second, if you do want in, size it like the high-risk bet it is. A common guardrail among sane investors is to put no more than 1 or 2% of your portfolio into any single IPO and to keep all your speculative IPO bets combined under maybe 5%. This is your fun and upside money, not your rent money, not your emergency fund, not the down payment on the house. If SPCX triples, 1 or 2% of your portfolio tripling is a genuinely great year. If it craters, 1 or 2% craters and your life doesn't change. That asymmetry, small bet, big potential upside, survivable downside, is the entire game. The people who get destroyed are the ones who hear biggest IPO in history and put in money they could not afford to lose. And if you genuinely can't stand the idea of trying to time it, which honestly is a very reasonable place to be because nobody can reliably time these things, there's a boring, proven move that takes the whole decision off your plate. Dollar cost averaging. Instead of agonizing over whether today is the right day to buy, you decide on an amount you're comfortable with and you split it into chunks over time. A bit now, a bit in 3 months after the first earnings report, a bit around that December lockup. You'll never nail the exact bottom doing this, but you'll never get wrecked buying everything at the exact top either. And over a volatile stock's first year, that consistency tends to beat the guy frantically watching the chart at 2 in the morning. It's not exciting. Exciting is what gets people in trouble. The unsexy automatic set it and forget it approach is how most regular people who actually build wealth in the market do it. And there's no reason SPCX should be any different. Third, and please hear me on this one, watch out for the scammers because a story this big is a magnet for them. The moment a company like SpaceX gets this much attention, the internet fills up with people offering you exclusive pre-IPO SpaceX shares or some tokenized crypto thing that supposedly tracks the stock or a too good to be true private deal with a tidy markup baked in that they conveniently forget to mention. If someone slides into your messages with an unsolicited SpaceX offer, the answer is no. Real access goes through registered, reputable brokerages and platforms, and you always confirm exactly what security you're actually buying. When something this hyped is in the air, the con artists work overtime, and fear of missing out is the single easiest emotion in the world to pickpocket. Now, I can hear a few objections forming in your head right now, so let me knock them down one at a time because they're the exact thoughts that stop regular people from ever participating. The first one is, Nick, I only have a couple $100. This is for rich people. And I get why it feels that way. Like for the secondary market stuff, yeah, it genuinely is for rich people. That's what the whole accredited investor wall is about. But here's the thing that's different now. Through those mainstream brokerages and through buying the stock or a fund on the open market, there is no minimum that matters. You can buy a single share, you can buy a fractional share, $20 of it if your brokerage does fractional shares, which most of them now do. The idea that you need to be wealthy to own a piece of this is the exact outdated assumption. This IPO is breaking. You don't need to be rich to start. You just need to not pretend that $20 is going to change your life by Tuesday. Which leads to the second objection. If I can only put in a small amount, what's even the point? And this is where I want you to think like the people who actually got rich off the companies we just talked about. The point of a small position in something like this was never to get rich tomorrow. It's to get exposure to a genuine long-term winner and then leave it alone for a decade. Let me make it concrete. Say you put in $1,000, money you've genuinely decided you can afford to lose. Like if SPCX does what its boosters think it'll do and roughly triples over several years, that's $3,000. Nice, but not life-changing on its own. But if you do that across 5 or 6 carefully chosen bets over your investing life, and 1 or 2 of them turn into a Tesla or an Amazon, that single winner can quietly carry your entire portfolio. That's the actual math of how people build real money in growth stocks. It is not one perfect bet. It's a basket of small ones where a single monster winner quietly pays for every dud you ever picked, with plenty left over. $1,000 in SpaceX isn't a jackpot ticket. It's one disciplined line in a much longer story. And the third objection, the sneaky one, it's already too expensive. I missed it. The early people got all the gains. And look, partly true. The 62,000% returns are gone. Founders Fund got those, you and I did not, and no amount of being mad about it changes that. But the easy money is gone is not the same as the money is gone. Amazon at its IPO looked expensive to people in 1997. It looked expensive in 2001, in 2010, in 2015. There has basically never been a moment where Amazon looked cheap on paper and it made fortunes the entire way up anyway. The question is never, did I miss the bottom? Because you always did. Everybody always does. The question is this a great company at a price I can live with for the next 10 years? That's a question about discipline and patience, and it's one you're fully equipped to answer once you strip away the panic. So with all 3 of those objections cleared off the table, let's bring this all the way back around because I want to make sure you walk away with the right takeaway and not just a pile of numbers. The title of this video asks 2 questions. Are thousands of people about to get rich off SpaceX? Yes. Unambiguously, provably, yes. The employees with their forgotten drawers full of options. The early funds that wrote brave checks when this thing was nearly bankrupt. The Googles and the founders' funds sitting on returns so absurd they'd get laughed out of a pitch meeting if they weren't real. That part is settled, but the second question, could you, turns out to be a more interesting question than it looks because the honest answer isn't a simple yes or no. It's this. For basically your entire investing life, the door to a wealth event like this has been bolted shut for people like you and me. You watched from the couch while the people in the room got rich, and your only move was to buy in years later after all the easy money was already made. What's genuinely different this time, what makes this worth a 50-minute video, is that the door is actually measurably cracked open. 30% reserved for retail. 5 mainstream brokerages, funds you can buy with $100 and a phone. The room has a seat in it. The catch, and there's always a catch, is that walking through that door wisely is its own skill. It's resisting the day one frenzy. It's paying a fair price instead of an enthusiastic one. It's sizing the bet so a loss is survivable and a win is meaningful. It's knowing the difference between owning Alphabet at no premium and overpaying triple through some closed-end fund with a rocket drawn on it. And the opportunity being open to you and you being ready to use it well are 2 completely different things. And the second one is the one actually worth getting good at because it's the one that'll still be true at the next IPO and the one after that. Think back to where we started. 13,000 people on the inside of that building about to wake up set for life and everybody else outside it watching through the glass. Picture one of those outsiders on launch night, a super fan watching the live stream on his phone muttering, "Told you so," to a living room with nobody else in it, then quietly closing the tab and heading to bed. He wasn't dumb. He may have called this company's future more accurately than half the people who got rich off it. He just never had a door. The folks on the inside didn't get there because they were smarter, they found a way in, and then they held on. For your whole investing life, the rest of us only had the couch. This is one of the rare moments where the couch and the room are sitting a lot closer together than they used to. What you do with that, whether you sit tight, dip a toe in at a fair price, or just enjoy watching the most insane IPO in history unfold, knowing exactly how the machine works. That's entirely up to you, but at least now, for the first time, it's actually a choice. If this broke the whole thing down in a way that finally made it make sense, do me a favor and hit that like button. It costs you nothing and it genuinely helps more than you'd think. And subscribe, because the next time one of these once in a decade money events comes along, I want you walking in already knowing the game, and I'm genuinely curious. Drop a comment and tell me which of the 4 routes you'd actually take. Are you requesting shares at the IPO price, waiting for the dust to settle and the lockup to hit, going the boring alphabet route, or just watching the whole circus from the couch with a bowl of cereal? No wrong answers. I read these. Thanks for watching, and I'll see you in the next one.